Wall Street and Main Street continue to wait for lawmakers to get their acts together and pass a second COVID-19 stimulus package. Here to talk about its impact on the markets, particularly the bond market, is Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Good to see you, Kathy. I know during the break we were talking about how it just seems like Groundhog's Day. You wake up and go, nope, still no deal on stimulus, still no deal on Brexit. What has the impact been for the market? Because I have a feeling it's starting to chip away at that bullish sentiment.
Yeah, it really is. You know, if you look at where the bond market went a couple of weeks ago, it looks like, the vaccine's on the horizon. And then, of course, we were going to get this fiscal aid package passed. And that sent yields in the 10-year Treasury up to almost 1%. It has elevated the riskier parts of the market, like high yield bonds, on the expectation that the economy is going to get rolling again and everything's going to look rosy down the road, and we can kind of see past this tough winter that we're facing. And now, of course, with the fiscal aid package stalling in Washington and some of the economic data deteriorating, now we're stuck sort of meandering around, wondering if we haven't gotten a little bit ahead of ourselves.
Speaking of getting ahead of ourselves, where do you see the yield on the 10-year as we wait for the stimulus package? Because I'm wondering if we don't get one by the end of the year, what happens to that yield?
Yeah, then I think it comes back down. Again, it pushed up near 1%. It's pulled back down to about 90 basis points. I think it could drift a bit lower. At the end of the day, I mean, the ultimate move is probably higher from here because we do have the vaccine coming. And actually, it looks like very soon, at least for healthcare workers and for a few other vulnerable populations. But once we get the ball rolling, then that allows us to open up more of the economy, lift some restrictions, get people back to the office and other places that they haven't been able to go. So that's the 6 to 12 month outlook. But in the meantime, we have a lot of vulnerable areas of the economy. So if we don't get some sort of a deal, then aid to state and local governments is going to mean more layoffs. We've already had 1 million people laid off at the local government level. We'll probably see more of that if they don't get some sort of aid package from Washington. And some of the industries that have been most adversely affected, service sector industries, will see more layoffs as well. We're already seeing jobless claims come back up. Could see a negative print on the December jobs number if indeed we don't get some stimulus. So a lot is hanging on it in the near term.
If we get that negative print for December jobs, does that really trip up the market? Or to some degree, has this market baked that into the equation?
Well, I don't think it's completely baked in. The jobless claims number that came out yesterday was higher than expectations. We see a couple more weeks of that, people will start saying, okay, we could see a negative print for December. And again, a lot depends on, okay, maybe we get through December, it's a bad, that's a bad number, but if we've got the fiscal aid, we've got the rollout of the vaccine, people might look past it, but the longer we delay, the more layoffs there are and the harder it is to come back. And there are some industries, some businesses, especially some small businesses, just won't make it through the winter without some sort of further help from here.
Look, we're always looking for yield, right? People chasing yield. Hard to find it right now. I know that you favor bonds with AA or higher ratings, but the yield might not be there. When you look at the municipal bond market, I know the risk appetite is a little higher there in order to play in that area, but are you seeing opportunities? I know a lot of our municipalities are hurting right now during this pandemic, but do you think that if you choose wisely, there is opportunity there?
Yeah, I mean, yields across the spectrum are low. I mean, we at least have some positive nominal yields in the U.S. and in Europe, they're mostly negative. So, but yields are low. But when you look carefully, yeah, we like some of the taxable municipal bonds that are out there. You can get a yield that's similar to a corporate bond with higher average credit quality. We like investment grade corporate bonds. We just don't want to fish in the bottom part of the pool there exclusively. But the yields are low relative to treasuries right now because we've been bid up. So there are opportunities. I think you just have to pick through it carefully. And I wouldn't go to the lowest tier, even if the yield is better, simply because the risk reward there is not going to be that attractive.
Looking ahead to next week, we've got the final Federal Reserve meeting of the year. Some on Wall Street might be banking on Jay Powell and company to be a little aggressive. Do you think that they're setting themselves up for failure in thinking that?
I think there is a risk. It looks to me about half of the economists surveyed expect the Fed to announce some sort of extension of the duration of the bonds that they're buying. In other words, buying more long-term bonds to hold down those yields. And about half think that might happen later. We're in the camp that thinks it might happen later. We don't expect it this time around. Despite some of the negative news that we're getting, I think when you listen to what the various Fed officials have been saying, they don't seem to be in a hurry. And what they really focus on is financial conditions. Are businesses able to borrow money at low rates? Are consumers able to get a mortgage at low rates? Is there enough money in circulation out there? Is liquidity ample? And the answer to that is yes. Financial conditions are very loose. And so why would they make a move right now? I think they would reserve some of that firepower to use in a situation maybe when financial conditions were to tighten up, then they could do something about it. But right now, I'm not sure that they would get a lot of bang for the buck in just announcing that they're going to buy more long-term bonds.
All right, we're going to leave it there. Kathy Jones of Charles Schwab, always good to see you. Have a good weekend.
Thank you.